Types of social investment. Many of the core products in the armory of a social investor would be familiar to any financial markets practitioner. Senior debt. A charity can incur senior secured or unsecured debt. This would extend from short-term working capital facilities to 40-year mortgages on properties. Junior subordinated debt. With an intercreditor agreement, this can slot in beneath senior debt with repayment only after the settling of senior obligations. Interest rates might average 8 to 9% for small charities versus 5 to 6% at the senior level. Charity bonds. This looks like a corporate bearer bond with annual coupons, standard bond documentation, including generic covenants, and sometimes security. The issuer is a regulated charity or social enterprise. Liquidity of the bonds is often low, with investors looking to buy and hold. The overall market size remains small, with only £135 million outstanding by year-end 2017. Charities also have access to other forms of finance, which are bespoke to the sector. Social impact bonds. In 2010, Peterborough Prison issued the first SIB, with a coupon linked to the rate of reoffending on the release of cohorts of prisoners. The bond was repaid 7 years later with a 3% return. This innovation in not-for-profit financing was an attempt to tie social investors into the outcomes that followed from their investment. It relies on an arrangement described as payment by results. SIBS combine 3 principles in each transaction. The commissioner defines outcomes to deliver an improvement in the chosen cohort. Deals have been done around prison offenders, health, employment, education, and social exclusion. The commissioner will often be a local authority, government department, or institution like the Big Lottery Fund. Next, the delivery partners are the charity or social enterprise that seeks to deliver the service that will provide improved outcomes. The service needs to be measurable and easy to administer. In health and education, for example, this may simply mean patients and learners showing up for sequential meetings, accumulating coupons as they move through the treatment, therapy, or lessons. Finally, the investors will analyse the special purpose vehicle, or SPV, where they lend, in terms of the integrity of contracts and deliverability of the outcomes. Investors will want to know that the arrangement delivers good without being too complicated or costly. As in many aspects of social investments, scalability of these financings can be challenging. SIBs are complicated. This means that structuring and legal costs are high and need to be spread over a significant size of bond or loan. Development impact bonds. This is similar to the SIB, but uses payment by results in the context of development projects. Commissioners here might be supranational development banks, and outcomes might be linked to improved agricultural initiatives or climate change impact. There have been few DIBs closed thus far. Lead times on these deals can be slow, with foreign exchange and legal complications. Community share issues. These are equity units issued by a community benefit society that allow individuals and institutions to invest in a local enterprise. They are normally raised in small denominations with a maximum single investment of up to £100,000 using a crowdfunding platform. The shares are technically redeemable with notice, but the issuer can decline to redeem due to insufficient financial resources. In that sense, CSIs represent permanent capital. The CSIs pay a rate of interest typically in the range of 2 to 5%. Revenue participation agreements. A loan that receives a rate of return based on some performance milestone, typically revenue-based. This is again an attempt to construct quasi-equity in the not-for-profit sector. This is the end of part 1. In part 2, we will look at types of social investors, the whole area of ESG, and a real-life example of a social investment fund.